Now, if I was Jeremy Allaire, is there a period of time where we could have launched a token and had it been a decentralized protocol? I think the answer is definitely yes. Now, would it be Circle today and would it be USDC today? Probably not. Would you be able to have $45 billion of market cap of your stablecoin? Probably not. Would you be able to own tens of billions of dollars of T-bills? Definitely not.
Yeah.
Like, the entire business is different. So it's kind of like,
yeah.
if we go back and say, okay, what if Tesla made a phone instead of cars? It's like, well, I don't know. It's impossible to say.
Hey everyone, quick shout out to today's sponsor, Namada. Namada is currently entering phase 3 of their mainnet rollout, so make sure you check it out by following the link in today's show notes. We'll talk more about Namada later today, but for now, let's get started. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Bell Curve Roundup. You got Michael's 1 and 2. Obligatory cut the fat joke. Dances in there. What's up, man?
The two best friends.
Holding it down, baby. Holding down the fort. Hey, happy Liberation Day to all those who celebrate.
We're T+1.
Yeah.
Feeling liberated.
Yeah, I mean, it's been pretty interesting. I think people have just consistently underestimated Trump's propensity to do what he clearly telegraphed that he was going to do while he was on the campaign trail, early days in office. He's kind of doing what he said he was going to do.
That is definitely true. I think, well, it's interesting. If you watched kind of like the market's reaction to the actual conference yesterday, what was first said was, okay, we're going to do 25% auto tariffs. And it was like, oh, okay, that's it. Great. Market rips. And then he pulls out the board and it's like, oh, wait, there's more. And it's like market drops.
Yeah.
Yeah, look, I think broadly, like, he is saying what he said he was going to, he is doing what he said he was going to do. And I mean, look, I have I studied economics in college. Tariffs are not good for trade. Either there is something that nobody seems to be able to see right now. There's some master plan, or there's some negotiation tactics that not, the rest of the world or Twitter is privy to, or there's going to be some real contagion and issues that I think are driven from these tariffs. Just in what sounds like the narrative, and the administration definitely has a unified narrative on this. They want to bring consumption back to American goods, American manufactured goods, or American originated goods. And that's not something that can happen overnight. And it's like I was with a friend last night and worked at a very large tech company here in the Bay Area that produces a lot of physical devices. You can imagine which company this is. And it's like, okay, when do you want to yeah, exactly. Our research in motion. When would you like for us to be able to onshore this? Because is it going to be in the 2030s or the 2040s? Because that's the time frame that it would take to be able to pull that back. And it's not even something that would happen in this presidential administration. Right. And that, I think, this was called out by a couple of Matt Levine in particular. Like, what if we just, and Aaron Sorkin, or Andrew Sorkin, not Aaron, called this out as well. Like, what if people just kind of like call the bluff and say, all right, well, we got 3.5 years. We're just going to not invest and wait till we see what the next president wants to do with this. Because that's a real potential situation that could happen. So I think that it's
when you say not invest, Michael, sorry, what do you mean?
Not invest in production of new goods, not build inventories, not kind of run through what they have right now, and basically just like take it on the chin for the next period of time as they wait for this economic impossibility to work its way through. There are some it seems like negotiations that are going on. But even that is not something that's going to happen overnight or in the next couple months or potentially even couple quarters. Like these are you're trying to steer a cruise liner like a speedboat, and so I think people now recognize it. The market now recognizes it. The market has sold off per the recognition, and I don't think it's going to happen. It's not going to change very quickly. That being said, if the transition has been from let's focus on the S&P 500 to let's focus on the 10-year rate, the rate is down. From election day until now, I think the number was like 4.79%. Now it's trading at 4.05. It is probably something that over time gets down below 4. That does have real effect in terms of economics here in the States because a lot of things are based on that. Mortgage rates, auto loans, basically any sort of consumer credit is going to be based around what those rates are. and that I think will have a benefit as well. But yeah, it is either there's some rabbit out of the hat motion that nobody sees right now, or these look like they're going to be painful.
Yeah, I would agree. I think, when Trump was talking about this, he referenced different periods of time during the US where we had tariffs. So like sort of 1700s period on, and actually it was a long time till the late 1800s where we didn't have income tax at all. Now, there are lots of confounding factors here. The Industrial Revolution was going on during that period of time. We're going from a very low base. Did we succeed at that point because of tariffs, in spite of tariffs? There's a little bit of confounding variables there. At the very least, to be fair to both sides, it's not like tariffs have never existed, right? There are lots of countries also that have tariffs against us, although the rub there is how they were calculated by this administration.
Right. Well, I mean, that's another subject to talk about.
Yeah.
Seems like the administration is conflating what a tariff is and what a trade deficit is.
Yes.
Because the calculation doesn't make any sense.
Okay, yeah, this is where I think you can construct a steelman case here for what's going on. However, in terms of how they actually came to the numbers that they had on tariffs against the US, I don't think there's much defense here. That this makes no sense. So, initially when they showed those boards, which you probably have seen on Twitter, let me see if I can find some of the pictures here of these boards. I think I had the same reaction as a lot of people. I was like, whoa, we're getting tariffed a lot. Holy crap. Like everyone has this amount of tariffs against us. Like, okay, maybe no wonder, right? And I'm sure that was the intended, like these boards,
Right.
where we're looking at reciprocal tariffs. And yeah, the idea is that the US is being benevolent here because you're basically looking at tariffs charged to the US, and the fine print is including currency manipulation and trade barriers. And then the USA discounted reciprocal tariff, which is the tariff we're levying against China in this instance, the EU, which is half of what they're doing to us. And then there's a floor of 10% as well on that.
There was one example that I can't remember if it was in what we just showed, but Lagos, and there are a few African countries that don't actually have any tariffs, but the entire trade equation is like we export $5 million of goods to this country. They import $245 million, or sorry, it's the reverse. So we have basically like a 99% difference or a 98% difference in trade with this country. That got put up on the board as there's a 99 or 98% tariff. That's not a tariff.
Yeah. Right. So the calculation that's being run here for folks is what they're just doing is they're taking the exports and dividing by the trade deficit. So imagine there's an example here that I'm looking at, Indonesia. There's a $28 billion, it exports $28 billion a year to us, and there's a $17.9 billion trade deficit. You take 17.9 over 28, that equals 64%. That's how they're getting to these tariffs, which I sort of get what they're driving at there, but it doesn't really make any sense. And there are lots of reasons why there might be a trade deficit outside of tariffs. This was always going to be complicated here. And this is the challenge, by the way, I think with, Trump Trump does. I don't know how to maybe put this into words. He really understands the theater of politics, and his solutions to things actually are overly simplistic and very narrative based in a way that's going to be, he can sell them to a broad, like build the wall, right? That's an example of a policy actually where you got to get it right. He identified a core problem, and probably the solution to actually solving immigration is this long process of, you got to address the policy. There's other technical solutions, maybe drones or whatever. That doesn't sound good though. A nice big simple wall sounds good, and that's sort of the way that I look at these tariffs too. It's maybe I think he put his finger on an actual problem. Is this the way to solve it, or is this actually a nice simple solution that he can actually ironically sell to a large populace? Maybe somewhere in the middle, right?
Yeah, I'm sure it's somewhere in the middle. Look, the art of the deal. That's all you need to go read to figure out how this works. It is. It's frustrating.
This episode is brought to you by Namada. Namada is the shielded asset hub rewarding you for protecting the multi-chain. Shield your data across any asset and any chain, and get shielding rewards for helping strengthen data protection for everyone. To learn more, follow the link in the description below. This episode is brought to you by Marinade. Marinade is a high-performance staking delegation platform that brings both liquidity and security to the Solana network by connecting SOL holders with the best staking rates on Solana. Follow the link in today's show notes to learn more. Michael, what do you think about the market reaction here? So we're actually down. I will say people are treating this like it's Armageddon. We're almost at parity to where the S&P was when Trump took office back in November. So I will say I have seen, and we could say this and then tomorrow when this podcast airs, the market could fall off a cliff and go limit down. But, the market actually has been relatively orderly here in the sell-off. Obviously, crypto's down a good amount. It does surprise me that the market hasn't sold off more on this news if you were to take it at face value. So my assumption is that the market is discounting that cooler heads will prevail here. What's your read on the
market? Well, it's one of two things. Either they're calling his bluff. The market is calling the Trump put or the tariff put, and it's not going to actually get implemented. Negotiations are going to relax these tariffs. Whatever happens isn't actually going to go through. I don't necessarily think that that's going to happen at this point. He's not one to back off. And I think having all of this attention on it just further entrenches the perspective. I think what is good is that this is all happening at once, where I think we could have gotten into a really even tougher place would be this week it's this, next week it's that, the week after that it's this other thing. And we just kind of, over the last couple of months since he started talking about this, it has felt like he's gone back and forth 2 or 3 times in terms of, what's going to happen, what's not going to happen. We're, delaying the implementation. It seems like there's a plan now. So everybody knows, and it's not surprise. It was surprise yesterday, but everybody now knows. And I think the other option is it's not going to affect as much because there will be either workarounds or there will be ways of mitigating this, and there will be certain companies that take much larger hits than others. I mean, yesterday, the Restoration Hardware CEO had the live chart as this was getting announced as he was on the earnings call and didn't see what happened, and into the mic literally goes oh shit. Everybody's surprised, right? Yeah. And so certain companies that are literally importing their product or their manufactured product to be sold in the US, they're going to have issues. Nike's down, I don't know how much percent, but they were 12 or 13% was what I saw earlier today. So maybe there is sort of a reevaluation of which companies are going to do well with this new construct and which ones are not. What will be really interesting is kind of what's excised out of this. And it seems like semiconductors had a pretty clear excise from this policy. And so maybe it is something where, certain companies, it dispersion happens where certain companies aren't doing as hot, certain companies are going to be okay. But that net doesn't actually affect that much in terms of the S&P 500 or the NASDAQ. What is unclear is what basically the retaliation could be. Um, you know, we are large exporters of digital services and digital products. What if those are reciprocally tariffed in the same way or gone after? That would be a much larger hit to the S&P 500 and the Nasdaq. Um, so I don't know. I mean, it is moving in real time, but I agree. I mean, the market sold off a lot, and this is definitely one of the larger single days in the last few years. But there's still so much to be uncovered. It's unclear as to what could happen,
Yeah.
and that's where I think another limit down day could be reciprocal digital services where the Mag 7 is attacked. Like if that was to happen, then that would have a much bigger effect than even what happened today.
Yeah. I saw a quote from Scott Besson, and this is one of those, DB accounts that, uh, so I don't know if this is actually 100% accurate, but this is a Mag 7 problem, not a MAGA problem. And, to your point, oh, by the way, just on the calculation of trade deficits as well, they just did this on goods, not inclusive of services. And as you mentioned, we export services. So just another pretty large omission here, but it also does, I think, tell you where it's one of two things, right? Either he is just so focused, and this administration is extremely focused on kind of the common man in Main Street here above Wall Street, or this is a very clever, there's another ulterior motive here that's being hidden that this, to my mind, relatively complete story is obfuscating. So I have no idea, but I do think that you know a huge problem in the United States for a very long time was that we were exporting middle class jobs overseas. And I think there was a decades long psyop that that's not the case. And don't you understand comparative advantage? And, the comparative advantage people are right on a global basis, but comparative advantage doesn't mean that has to accrue to everyone equally. And it was really disproportionately hurting a large portion and voter base in America. And so, my thought on this is I don't like this. This does not benefit me. I do not like these policies. However, this is what you get. This you reap what you sow. You did not solve this problem. You gaslit this huge portion of the population. And you know what? Finally, there has to be the pressure built up and it exploded out of a valve, and it could have been any valve, but the valve happened to be populist policies and tariffs. So there you go.
Right, and I completely agree with all of that. I think, yeah, this is definitely a reshifting of Wall Street to Main Street,
Yeah.
and I guess the broader point is that reshifting isn't going to happen overnight. It's not services and it's not digital that we're talking about. It's physical products and physical manufacturing that we're talking about onshoring again, which takes time. I think for that reason alone, there's going to be more market pain, and yeah, it's there's still so much to unravel with all of this, and the reactions. I think people are still digesting. Our trade partners are still digesting how this will work and what this will look like. I think the implementation dates are like April 5th for some of these, April 9th for some of them. So they're coming very soon, but it'll be really interesting to see kind of what the reactions to all of this will be, because that will dictate new earnings forecasts, new revenue forecasts, like all of that has to be re-underwritten.
Yeah.
And I think maybe that's one of the reasons why the market hasn't sold off as much as people would have expected, because we still just don't know. And there's the knee-jerk reaction of like, okay, get to cash, sell, and wait. Or there's the other reaction, which is we just don't know. So, and the market's already down so much in the last month and a half.
Yeah. Right.
You want to wait and find out more information before you make a decision like that, which could lead to further days like today.
Yeah. One thing that I want to get onto our next subject of conversation here, but one thing that had surprised me going back to the pandemic was I remember they were doing all these shutterings. So I can't remember what they've furloughs of jobs and
Yep.
things like that, and subsidies, and the PPP loan era, or it's not even a loan, they just gave away money. And I remember thinking, Oh, this is interesting the way that it makes sense that they're actually protecting like big corporations because I just assumed that that was the majority employer in the US. Actually, turns out it's the opposite. It's small business employs two-thirds of the US people in the US. And so I don't know. I've seen all these people come out and say, well, Main Street is cheering this. I haven't seen any evidence that they're cheering it, but I do anecdotally know. I got a buddy who has a small business up in upstate New York. He's got a loan and he's getting crushed on interest payments,
Exactly.
and he doesn't give a shit about the stock market.
Right.
And yeah, this is probably more impactful to him. So it's still like who knows, right? If this causes a recession, then the damage again to my friend's business would probably be worse than the interest rate differential. But there might be some truth. It just depends on how it all plays out, right?
And that's exactly it's exactly right. It, once again, too early to tell,
Yeah.
but the reason why we probably haven't heard Main Street's perspective is because they're probably not on Twitter or they're not in the same Twitter circles that we are.
Yeah.
And so the vocal reaction here is coming from people who have assets that are down 4, 5, 6, 10% right now. And yeah, I think Main Street will benefit from this long run if we can get the interest rates down, if we can get um, even some of the basic building blocks back, and it doesn't have to happen immediately. But if we can start to focus more on manufactured goods here, and maybe this incentivizes the creation of more, like I just saw. I don't know if this is pre-planned. It probably was, but TSMC and Intel are starting, a JV to do chip manufacturing again in the U.S. And I think that type of move, Intel's in a troubled position right now in general. So I will be curious to see kind of what that means. I just saw the headline, but there could be moves like that where they start to look at, okay, well, it's going to be better for us long term to start building more in the U.S. Then there's the question of like, okay, does the average person want to go work in a manufacturing center, or if you're building chips, the comparative advantage, the competitive advantage of Taiwan is so strong that it's so hard to find that particular skill set of people in the United States who are PhD level material scientists or electrical engineers who aren't going to go take that 500K a year job at Google to go be a software engineer working on AI. Instead, they're going to go take that 200K a year job to go be a manufacturing engineer. That is kind of the trade-off that we're talking about here for certain industries, and manufacturing chips is one of the most technically complex things you could possibly do. But I think that is one of the structural situations that we're trying to right the ship on, but it's going to take time.
Yeah, I think there is a path that element of path dependence here where I understand the drive and the impetus. We want to reverse some of the effects over what I'm very sympathetic to is, people saying, "Oh, this is so disproportionately bad for poor people. Look at how much you're making a TV cost." It's like, guys, I mean, we hollowed out their jobs and the middle class and the livelihood and shipped those overseas, and what they got was the cheap. So now they're the idea is they're kind of clinging to the scraps, but I don't think that I I I do I'm not very sympathetic with that point of view. However, I'm also kind of sympathetic with the view that you can't just run that whole thing in reverse, right? What's been done is done, and there are different pockets all over the world of we got a bunch of people who've grown up thinking manufacturing is the way to lead a better life in Taiwan and China and South Korea. We don't really have that as much in the US. I don't know how you're just going to reverse the clock on that either. So I actually just don't know what the solution is, and no one really does. But I guess we'll just have to see. And yeah,
Look, as someone who spent some years studying economics, what a fascinating time to be alive.
it is a fascinating time to be alive. And you know what? I think it's a good time to be alive in crypto. I would shift our topic of discussion here. One thing I'm curious to get. We talked last episode about potentially IPOs and M&A happening. So I'm curious to see whether or not you think that disrupts that. But the other thing is Circle, after very long awaited, I believe this is their third bite at the apple here. They have filed for an IPO,
Yep.
and their prospectus came out, and we finally got to take a look at it, and we got to see P&L, balance sheet, cash flows of the business going back 3 years, which was super interesting. So let's start with the Circle piece.
Yeah.
Here, I'll let me find Nick Cannon from Gauntlet had some interesting takeaways. But here, I'll read from the P&L going back to here. I'll just throw this on my screen so everyone can look at it. But the P&L going back to 2022 tells a pretty interesting story, which is so back in 2022 they actually lost. Was that 760 million there?
Yep.
Yeah. Wow, big loss. And then they turned it around 2023. Top line growth of they did 271 million, shrunk a little bit in 24 to 156. A lot of people are paying attention to there's the channel costs, which we'll get into. So the top line growth has been all right. Like there's a big market cap reason, and then there's also a yields reason, which is driving the revenue. But a huge amount, a huge data point that the market is focusing on is how much is Circle paying out to channel partners. In particular, Coinbase, was the big one where, something like in the last year, 900 million got paid out to Coinbase out of 1.6 billion of top line, and that I think that number really surprised people. And yeah, I mean we've talked about this as well. I think we talked about this relative to Tether, where the sort of the rumor was they don't pay an enormous amount in to distribution partners, where Circle did, and now we actually got to put some numbers to what they have to pay out to not only Coinbase, but other market makers, exchanges, whatever. So, what were your takeaways looking at some of the numbers?
So on that $761 million loss, I think they also paid something like 700 million that year. They had, so like the EBITDA numbers are probably better than the net income numbers because they had some financial transactions internally that skewed 2022. I think I saw something that may have been them buying out basically the center equity that they owned, or the center ownership from Coinbase. So that's a little bit skewed. Yeah, look, I mean, these guys are making, whatever the number was, like 151 million a year in net income. And I think it's more than that in cash flow and more than that in EBITDA. But you compare that to the 13 billion in net income that Tether made last year, and it's not really a comparison. The kind of Twitter meme that I saw was Coinbase makes more money from Circle than Circle does.
Yeah. Yeah.
Yeah, there's a lot of incentives that are given out. And I think I don't see that necessarily changes. I think once you kind of tap that spigot, you can't really turn it off. And unless you go through the process of something like regulatory capture, where you become the only one that's enabled to operate in certain jurisdictions. Now, I think there's also an interesting thing going on in the backdrop, which is, and we talked about this a bit, but yield-bearing stablecoins seem to be cut out of at least the Genius Act, potentially the Stable Act as well. We'll see kind of how both of those play out. But do you consider, a stablecoin like USDC, where you put it on Coinbase and you can earn 4%, is that yield-bearing? Unclear. And so maybe, they're limited in terms of, offering that service, and what does that do to growth? What does that do to kind of the viability of the asset? Unclear. But I think that they will have a successful IPO. I think that there's definitely public market interest for crypto companies. I think the question is, where does Val end up, landing? The rumor was somewhere between 4.5 and 5 billion off of a net income of 150 million. That's, it's a sizable price to earnings. But if you think about sort of the direction of where stablecoins are going, being having a regulatory framework in the United States, the growth of the stablecoin industry, at least we think, is about to explode. Circle is number one or number two globally, and number one in the U.S. in terms of adoption. We don't think that That positioning may adjust over time, but they're going to be one of the top stablecoin providers, issuers, kind of into perpetuity is our take.
These were the numbers that I was referencing before. This is James Ho of Modular Cap. But there's a nice little distribution of Circle revenue chart that got put out, which is measuring looking in 2024 of 1.7 billion in revenue, 900 million plus got paid out to Coinbase as a distribution partner. Now, one thing that I think does bear mentioning is James, and no offense here, James, I'm going to disagree with a slight part of your point, is that's 1 billion going to Coinbase likely comes with little to no cost / OpEx to serve. At 10x earnings equals 10 billion of market cap and likely contributes to 25% of Coin's valuation. I will say that Coinbase does actually pass a lot of that back onto their users. If you hold USDC at Coinbase, you've been making anywhere from 4 to 5%. I think still for holding.
I don't know what their net interest margin is, but I would imagine it's in the like single digit to maybe 10 basis points. I'm saying at Coinbase. So, if treasuries are yielding X, they're distributing Y, that difference is very small.
Yeah. So the real winner here actually is, it should be users, right? Like this is and there was a long, I read an article actually about, the beginning of money market funds back in the day. And there was huge resistance to money market funds at the time as well. And yeah, for a bank, if you're running a NIM, like a net interest margin business, having to pay users, it directly erodes your profit margin. And so
yeah, it's your cost.
It's your literal cost. Yeah, it's your cost. So yeah, I think even though it's didn't make it this way through the stablecoin bill, I mean, the fact that Circle is still passing that yield back to users, at least for the time being, I think is good. It might be a structural advantage for certain DeFi protocols that lean into that as well, being able to offer yield, I think, to.
Well, so to be clear, I think the only way to actually get the yield is if you hold USDC on Coinbase.
It is.
And so I don't think that, at least I don't believe this is the case where Circle is providing yield either to users of DeFi or protocols in DeFi.
Correct. Yeah, I think there will just be I guess the macro trend that I see here is there's a lot of different issuers. There's going to be a lot of different stablecoin issuers, and it's sort of, if you don't have distribution, it's very hard to figure out how to compete here outside of trying to find a way to return yield to users. And Coinbase is an example of how they've kind of got around that, right? Like they are passing back essentially the yield from USDC onto their users.
Yeah, and I mean, look, this is a question that we have, which is how does that work within the confines of the draft bills that are working their way through the Senate?
Yeah,
it is unclear. Does that get cut because you can't have a yield-bearing stablecoin? Unclear. What does that do? Well, it probably favors Tether pretty heavily.
Yeah.
Like if you were to cut down all the incentives for USDC, what happens to growth? I mean, it's not like it probably doesn't decimate, but it definitely hurts growth prospects.
Namada is the shielded asset hub rewarding you to protect the multi-chain. Built to give you full control over sharing your personal information, Namada brings data protection to existing assets, applications, and networks. Namada ends the era of transparency by default, enabling shielded transfers and shielded cross-chain actions to protect your data even when interacting with transparent chains. Namada also introduces a novel shielding rewards system. By holding your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect NAM rewards in return. To learn more about Namada, follow the link in the description below. Hey everyone, quick shout out to today's sponsor, Marinade. Since launching in 2021, Marinade has expanded their suite of products to provide solutions for both DeFi users and TradFi, including liquid and native staking, as well as direct enterprise integrations. Marinade's platform is optimized for institutions to securely expand their exposure to Solana. Whether through the provisioning of custodial or non-custodial yield, integrating staking rewards into Solana financial products, or leveraging Marinade's best-in-market rewards rate for revenue and treasury management. Whether you're in DeFi, TradFi, or somewhere in between, Marinade has something for you. To learn more about Marinade, follow the link in today's show notes. What do you think about Circle's business here? Just I mean, they're still generating an enormous amount of operating. Their cash flow actually looks much better even than their net
Right.
income. So they're still generating an enormous amount of free cash flow here. Uh, the net income is trending in the wrong direction. The top line is trending in the wrong direction, but still, still it's a good business. I think the estimates that I've seen is anywhere from $3 to $6 billion, something like that,
Yep.
window. And what do you think about how would you underwrite pros and cons of the business here?
Yeah, I think you would have to take a pretty like market centered approach to how you build a strong valuation model that gets above, like, let's say a 10 billion plus valuation, and not in the IPO window, but probably in the next 3 to 5 years window, which is just that they're going to be one of the few, if not one of the two or three regulated stablecoins in the United States that have scale. And by scale, I mean anything over 5 billion plus. There's effectively three stablecoins that do, which is USDT, USDC, and USDS. If you're one of those three, you do have a Lindy effect that I think is extremely strong. While I do think that there's going to be a lot of entrance into the stablecoin market, I think it's never been easier to start a stablecoin. It's also never been harder to hit scale with a stablecoin because of all of these variables. The massive amounts of incentives that Circle is pumping into Coinbase for USDC, the massive profitability and distribution that Tether has, and how they can wield that. And USDS is growing rapidly and doing differentiated things, like using its balance sheet in more interesting and I'd say bespoke ways. We talked about this on stage, but I think, yeah, if you're one of the three, where do you think the stablecoin market goes from here? It's at 230. Do you think it could hit $1 trillion in the next 3 years? If you do, it's probably a good buy. The implementation of, okay, this is a business. I mean, cash flow positive basically means default alive in this, at this point in time. And they're definitely default alive. So you don't have to worry about that. And I think the question is, how do they work within the confines of whatever this, bill ultimately ends up becoming? Are they the only one? It doesn't seem like there's going to be regulatory capture for a single product or a single company. There's going to be competition. At least there's going to be a bilateral agreement that Mika and whatever this ends up becoming will be kind of like on the same playing field. So there will be competition. It's not going to be a winner take all market, which is how it should be. But how do they get the growth? How do they get the profitability up? It all comes down to it comes down to two things. It's how do you get more on chain? So how do you get integrated into major institutions or major vectors of asset AUM that you don't have access to now? Now, maybe this is RWAs, maybe this is private credit, maybe this is other things that kind of underpin all of this. That would be the biggest growth vector that I think they haven't been able to tap into yet. And I think a lot of those financial institutions are probably waiting for the Stablecoin Act to be able to actually know how they can interact with stablecoins in general, where they haven't had a clear roadmap to yet. And then the second variable is how do you basically decrease costs? So how do you increase that net interest margin? Because their business is basically in a weird way, it is kind of like a bank. You earn a certain amount based off of whatever the yields are of the assets that you can hold underlying the stablecoin, and how much you're paying out as incentives, and the difference is what you make. And so how can you decrease cost, increase that net interest margin? How do you grow the size of the pie in terms of the total AUM? But on the opposite end, what happens if there's a JPM USD or a B of A USD, and those start to take share from some of the US-centric use cases of USDC? I mean, we use USDC to fund investments. We hold USDC as like a balance sheet asset in lieu of cash at a bank. And we obviously have, our fund assets spread across, but we definitely still hold some USDC in basically like a bank deposit format. And so having that in USDC, I think is helpful. But if we have a JP Morgan account, and let's say Coinbase decides to integrate, a JP Morgan stablecoin. Well, what's the difference between us holding USDC versus holding JPM coin? I think we don't even earn the yield as a prime custody account holder, so we're not even in that realm of getting the 4% back as most users are, and we wouldn't get that back if we were using JP Morgan coin as well. So it's not even like a trade-off that frankly matters. Now, if we're going to use it for productive things, maybe we can't fund an investment with JPM coin, but we can with USDC. So then we're going to hold USDC. Like these are kind of the evaluations that at least us as a crypto native institution would be looking at. Users in retail, I think USDC to USD is basically how people bring assets, at least in the US, on and off chain. Just the one for one instant liquidity that Coinbase provides is strong. So I don't see that necessarily changing. But once again, if you have a JP Morgan or a Bank of America account, maybe you eat into that share a little bit as well. So there's definitely ways that you can look at the business expanding. But I think at the same time, part of that expansion comes with more competition.
Yep, I agree. And I also just want to correct something. The cash flow from operating activities actually for Circle is trending in the right direction. It's up.
I was going to say, yeah, cash flow I think is trending. Look, I think with any of these companies that are about to go public, the net income is kind of a wonky metric because you've got like non-cash costs that are associated with like equity conversions and stuff.
Yeah, I don't know if you can see here. Let me zoom in on my screen. Oop. Yeah, here there should be cash flow from operating activities. This is kind of the source of truth, in my opinion. And yeah, in 2022, the trend here for those following along, not on videos, they net cash flow or negative cash flow of 72 million. Then that went up in 2023 to 139 million. And then this year it's 344 million. And you can actually see that particularly what's impressive here is, you build a, operating cash flow starting with net income. So they're actually starting on a lower base from 2024 compared to 23. But the differences here is, it's stuff that you would like to see as investors, right? It's like stock-based comp. They're paying way more in stock-based comp in 2023 versus today. And there's a huge difference in accounts payable and accrued expenses. So they're getting ahead of some, they made some big payments last year that they're actually seeing the fruit of this year. So yeah, I think that I agree that I think it's a good business overall, and it should do well from the growth of the entire market cap of stablecoins. It is interesting to think about how it will compete. I feel a little vindicated. I've actually been hearing people describe stablecoins as a form of narrow banking, which I think we've talked about on this podcast. But yeah, it's, big light bulb moment was Brian Moynihan just describing stablecoins as tokenized bank accounts.
Right.
So yeah, it's kind of an interesting thought, actually. I really wonder how banks are looking at this because, if you think about it, the trend is there are going to be a bunch of dollars that move on chain in the form of stablecoins. The competition between different issuers means you probably have to pay out, do what Circle's doing with distribution partners and start doing rev shares. Where would you do it? You'd probably do it on exchanges and things like that. So if I'm imagining like JPM coin starts to trade here, right? Or all of those bank deposits that are just, you think of as dollars, which are JPM coins, become tokenized. And in the stablecoin form, currently what that looks like is non-tokenized, just dollar form, is all of those dollars they basically print and they put into a portfolio of fixed income, right? And then there's a net interest margin, there's a spread there that they're taking. In stablecoin land, you are actually depositing in your those are backed by short-term treasuries in the form of Circle, like T-bills, and then they're going to have to split some of that yield with, right, they're going to want that to be adopted at exchanges and brokerages and yada yada. So this actually feels disruptive to banks. So I'm not surprised that in the stablecoin bill they're like, oh nope, can't pay yield out, but you can't pay yield to users, but you can pay to distribution partners, channel
Right.
partners.
I mean,
It feels disruptive to banking.
It could be, but what if banks? So let's say the vast majority of depositors come from Bank of America and J.P. Morgan into
Yeah.
Coinbase. What if all of those banks got together and said, whenever a user wants to deposit, the only format that you can deposit into Coinbase is in our stablecoin? I mean, that completely kind of negates the whole USDC USD conversion right there. That, like, what's and if your average user is like, oh, I want to go buy some crypto, what's the best way to do it? Oh, well, I'm going to go and you put $1,000 from my JP Morgan account, from my Chase account on chain. Well, the format by default from a JP Morgan USD account into Coinbase is JPM coin. You're probably going to want to trade with that versus like do another swap and then do another swap.
Okay, someone walked me through this exercise, and I still don't really know what to conclude from it. But imagine just for a second, without getting too complicated, that a bank were to absorb a large stablecoin, what that would look like from a balance sheet perspective. So you have a bunch of, imagine the balance sheet of a bank today, which is a bunch of a portfolio of fixed income. So you have maybe like T-bills, but also longer duration, like 10 years, that type of thing. You might have some private credit. You might have some real estate, like whatever it is, right? You've got that portfolio where the lowest yield is T-bills, right? And then it kind of goes up from there when you take on duration risk or credit risk or whatever it is. And then you've got, customer dollar liabilities on the liability side of the balance sheet. Imagine you move a stable coin into that environment. Okay, so on the liability side of your balance sheet, you like one liability denominated in US, like JPM coin versus stable coin, it's the same. But then what you're moving onto the balance sheet side of the equation is a bunch of T-bills, which have the lowest amount. So you have to be dragging down the net interest margin of the bank, right? So
it is not an accretive transaction.
it is not.
The bank with the buy circle.
And the reason it feels like a truly disruptive technology to me is because I think banks will look at that and say, this makes no sense to me. I'm literally just, my net interest margin is eroding here. But what stablecoins can do is they have two big advantages. Is one, they're global from day one, right? Right now, the US banks are limited to deposits that exist within the US. Stablecoins can be anywhere. And because you're not taking on as much risk on duration, different types of securities, they should be more lightly regulated, right? They're like lower overhead, right? And they're safer in a lot of senses than banks are. So
what one part of this, and all the banking regulations, I'm not an expert on, so just quick disclaimer.
Yeah.
But let's say that there's strategic value in buying Circle. Let's say JP Morgan was to buy Circle.
Yeah.
What does that get JP Morgan? Yeah, the transaction itself, I mean, independent of the value of whatever it would be, the transaction itself is not accretive to their balance sheet and sort of like a net interest margin acquisition. But it is in the form of looking at this as basically an acquisition of deposits and potentially depositors.
Yeah.
And if you've got dollars that are being held in accounts that are then, converted into T-bills or whatever yield bearing assets they have on the back end, that may be something that, because of the Basel requirements and being able to have leverage on top of deposits, maybe that's where it actually does look like an accretive transaction. And how much would they want? And I can't remember what the numbers were, but they've got there's $45 billion of USDC, give or take. That's $45 billion of deposits that they can use as balance sheet addition. How much is that worth to JP Morgan? What I do know about IPO processes is that as you're going through the process, as they are right now, you also run a parallel process of, do we want to go public or do we want to seek a potential strategic acquisition?
Yep.
And so they are absolutely, or maybe they already have had conversations with all the potential acquirers who would look at this and say, okay, well, here's how it would function. And think about it from JP Morgan or any bank's perspective. It's like, okay, we get, right before there's a stablecoin act that regulates stablecoins in the United States, we get, to buy the largest one that's, largest issuer in the United States. It is definitely valuable to us from a strategic perspective, but it could be valuable to us from a balance sheet and net income perspective as well, depending on some of the Basel requirements and how they would look at it, how they'd be able to evaluate new customers versus existing. But I mean, if it's at $4 to $5 billion, this thing's valued like a tech company. It's not valued like a financial institution.
Yeah.
So,
Yeah.
that's where the rub kind of is, where it's like, okay, do you want to go public and try to show everybody that you're, a tech valued financial services business, and hope that lands, or do you want to find an acquisition? I don't know. It'd be interesting.
Super interesting. One also thing that might be a little bit wonkish is, what percentage of this is a very possible thing that could happen, right? Is you take dollars from your JP Morgan account and then you transfer that into USDC. How would you account for that on the balance sheet of JP Morgan? I actually you have those are you double counting deposits?
An internal transfer, I think.
Yeah,
it wouldn't actually affect anything. I mean, look, I think the value of Coinbase or Circle to a JP Morgan like acquirer is that you get probably a lot of new customers, because I don't know how many of them are also JP Morgan customers. Probably a large proportion, but I'm sure you get new ones. You get obviously the balance sheet hit immediately, and you can look at those as deposits, and that is the lifeblood of a net interest margin business.
Yep. Totally.
So, there is value in it. Is it worth $4 to $5 billion? Not for me to decide.
Traders, AI enthusiasts, and degens, listen up. The game is changing, and Desk is leading the charge. To celebrate their launch, Desk is running a trading campaign with 3 major highlights. 38% of their token supply will be allocated to airdrops. They're offering the lowest trading fees on Earth, and finally, they will be running a Desk referral program. The more people you invite, the bigger your rewards will be. To get started, click the link in the show notes below and make sure to follow at Trade on Desk. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today.
Okay, here's a final question for you. Do you think there was a moment when Circle could have launched a coin or a token instead of trying to go IPO? Like, if you had been knowing what you know now, and if you were Jeremy Allaire, we shave your head, you're Jeremy, and you have the choice. Do you try to do an IPO? Do you launch a coin? If you even have the benefit of going back at a moment in time, if you could have launched this in 2022, pre the banking crisis or banking, challenge where the USDC depegged, and I guess on a larger meta level, sorry to pile a question on a question, but how do you think even like Coinbase, right? If Coin were to issue a token, do you think you'd get a better valuation in crypto markets, or do you think you'd get a better valuation on US capital markets?
Look, I think what we're trying to figure out as an industry is what are the valuation heuristics that matter for tokens.
Yeah.
And so I think it's extremely hard for us to be able to say right now whether or not, apples to apples comparison in equity versus a token has higher or lower valuations. In the fullness of time, you'd assume that they're the same. And in general, I mean, this is where it becomes a question as to okay, how do you build a valuation model? And, is 100 price to earnings token, 100 price to earnings equity something that's, fairly valued? Well, it could be, depending on what that means, whether that's growth prospects that people are expecting, whether that's the value of, I don't know, Tesla in 2013, because everybody expected that it was going to continue to grow and they were doing something totally differentiated, and you want to own the equity because they were going to grow into that valuation, actually far supersede even the wildest analyst expectations. That's one method of thinking about growth stocks. But from a values analysis perspective, or a valuation analysis, it's not fairly valued. And so I think if you look at something even today, like any of the major L1s or even Bitcoin, like you can't value Bitcoin based off of a cash flows basis.
No,
It's
no,
the
no.
moneyness. It's
Yeah.
the store of value, digital gold narrative. And so there's all these things that are kind of like intertwined. Whereas in equity land, there's kind of two paradigms. There's like value stocks and growth stocks, and both of them have the same heuristics because everything's been standardized by SEC accounting standards, which is profitability, cash flows, revenue, and growth. And evaluating the business on an apples to apples basis, I think it's a tough thing to do. Now, if I was Jeremy Allaire, is there a period of time where we could have launched a token and had it been a decentralized protocol? I think the answer is definitely yes. Now, would it be Circle today and would it be USDC today? Probably not. Would you be able to have $45 billion of market cap of your stablecoin? Probably not. Would you be able to own tens of billions of dollars of T-bills? Definitely not.
Yeah.
Like, the entire business is different. So it's kind of like,
Yeah.
if we go back and say, okay, what if Tesla made a phone instead of cars? It's like, well, I don't know. It's impossible to say.
Yeah. I feel you. It's a difficult thing. It's I've actually been seeing people there's kind of this idea of like a super app that this is something that people have talked about in crypto for a long time. It's like the L1 plus the stablecoin plus kind of a vertically integrated stablecoin L1 plus a bunch of applications on it.
What will be really interesting is, and we're investors, we're very excited about it, but an L1 that is dedicated to stablecoins would be very interesting. And Plasma is going after this, where they're a Bitcoin based, and they've released some of the technical docs, but they're a Bitcoin based consensus layer, EVM compatible with zero fees for stablecoin transfers. So I think that will probably be the best, A/B test, let's say, for does Circle equity or Plasma, network value, in the fullness of time, which one of those does better?
Yeah. Michael, let's close here. Just speaking about tokens, I would love to get your sense on the ground here of what it's like to, there are a bunch of founders that are probably thinking through, as they always do, like, should I be launching a token? And part of that, right, is there's a market cycle, like where are we in this current market? There's a component around maybe for a little bit later stage, what does the IPO or M&A market look like? But could you maybe walk us through starting from the beginning, right? Like, I don't know, any lessons learned or sort of, best in class advice for especially founders on the earlier stage side of things? Like, what do you absolutely need to have, or how should you be thinking about token launch?
So yeah, taking a full step back. We have this conversation all the time when we're looking at early stage investments, where there's a lot of times where I think founders who maybe come from the Web2 world, or I think about it, or maybe just don't have as much experience in the Web3 space, are like, oh yeah, we're gonna build equity and we're gonna have revenue and it's gonna be flowing to the equity, and like we're also gonna do a token. It's like no. There are effectively zero examples of where you have both a successful value for your equity and a successful value for your token. You need to choose one. And I think that's the starting point. So you're either going down the path, like, should we launch a token? Should not be a question.
Yeah.
You're either launching a token or you're building value to your equity, and you have to make that decision basically at the start. And now there's a question of when should you launch a token? And those are two different questions. I think there's sort of like which year type when, and there's also like which month or which quarter within a year. Those are also two separate questions. I think what we have seen more recently, and I think that this is kind of what happens when you have a profligate funding cycle in 21 and 22. You've got a lot of founders who were basically looking at 2023, 24 as like build years. Maybe they raised like a bridge round to try and get them to the next bull market. And they're just stretched so thin, and they're finally limping across the finish line with like a half-baked product that isn't really working. And they're like, all right, and we're going to launch a token. Everything's going to be great. Guess what? doesn't work. We've seen a couple of launches recently that have no centralized exchange support. They have no market making support. They have, they launch a token with a Uniswap pool, and it's like market cap, fully diluted market cap, $3 million. Launching the token as the Hail Mary is like, I don't know. It's like last ditch effort. And it just obviously never works. And, when to launch a token. And look, the reason why there are lockup schedules of token unlocks is not because let's just like hold people back from getting these assets. Those are baked into an understanding that that's the period of time that it will take you post-launch or post-mainnet, post-token genesis event to find product market fit. And you should be well on your way to doing that by the time you launch. Otherwise, you won't have a successful launch. I think last year there were like 60 token listings on Binance. It's like one per week. And if you're not at that level, if you're not, at the bar of being able to list on Binance, it's not going to go very well, probably. And like we think of like the stack rank of exchanges in terms of, which ones are the best places to launch. And there's jurisdictional things, like if you're in the US and you want to have US coverage, like Coinbase is the pinnacle. And if you're in Korea or want, coverage of, the Korean market, Upbit is the best there. But rest of world is Binance or bust. And so getting a Binance listing is a very coveted thing, but it's also that just as great as that is, it is that much harder to get one because they want to see the growth metrics. They want to see the users. They want to see the TVL. Like it's not something, and it's actually kind of funny because one of the reasons why Binance became Binance is in 2017, they just listed everything. But now it's like by far the hardest one to get listed on. And so I think this is also maybe cognitive dissonance in the founder community right now. It's like, oh, well, we'll just launch it. Like, no problem. Like it's not how it works. And all the other stuff that comes with this is like getting the community ready, getting the node operators ready. Like there's so much blocking and tackling that it takes just to like get to mainnet. And that's when things start. That's not the end. And so being able to have, the product market fit enough to be able to show growth, adoption, and strong prospectus going into the launch, but then also having, what we say is you need to have 9 months of successful product launches and partnerships and integrations and growth post-launch. Otherwise, you'll be, one of the tokens that launches and then everybody forgets about.
Yeah, it's, crypto is the story of, it is funny because every time I hear that, sometimes people often say the easy money's been made. People love to say that. And I've heard that in almost every era of crypto that I've been involved in. People like to say that a lot. And in some ways, crypto is getting easier, actually. Like if you're building on the raw building on infrastructure used to be so difficult. But in a lot of ways, it's getting tougher also because like centralized exchange listings are a great example of that. So yeah, I would definitely say that. And I think it's a very positive thing as well that you don't have people that are just like, yeah, I'm just going to launch this token and that's my, that was never good for the market.
Slap a token on it and call it a day. Like that game was over in 2021, to be honest. I think we also had a lot of, honestly, just like faked founders that were like, oh, well, I like couldn't cut it being a, entrepreneur previously. So I'm just going to do crypto stuff. Like those people are gone. And I think, easy money, man, you think it's hard being a startup founder where you're like worried about the next, milestone or the product launch, whatever. Try sleeping when you have a 24/7 token that trades and a network that's live and you're trying to hold the ship together over that period of time. Like it's being a founder times 10, being a crypto founder with a live token. So I like, this is part of the evaluation that we have whenever we talk to people. It's like, why do you want to do this? Like, are you sure?
I'm going to drop a link to a podcast in here that my buddy Miles sent to me, but it's a 20-minute show, Hamilton Lane podcast, where they're describing the condensing or the convergence of private and public markets, where private markets are large enough and there are sophisticated enough buyers now that they want things like monthly liquidity, but they see tokenization as the bridge in between, like bridging the gap there. Super interesting. Drop it in the show notes. And yeah, I would just say if you're building in this space, especially if you're in DeFi and you have to, you can get hacked at any point and lose hundreds of millions or billions of dollars. You're doing it on ultra hard mode, and yeah, I've got nothing but respect, and it is extremely difficult. So.
Kane from OG Synthetics Days had a tweet thread about this the other day where he was like, yeah, I just didn't sleep for 2 years. 3 years. It's like you'd go to sleep and you'd want to get 8 hours of sleep, but you think every single time you wake up and check your phone, you're like, okay, great, we didn't die overnight.
We didn't get hacked.
That's what life is like.
Savage mode. But all right, partner. I think we're out of time here. Got to end it, but this was a good one, and see you back here next week.
Perfect. Thanks.